Hi, everybody. My name is Jennifer Burns. I'm head of the Business Insight Center at the Central Library of Rochester and Monroe County. Welcome to Insights on Demand. Today, we're going to be talking about corporate structures, corporate legal entity structures. Our guest today is Michael Gianta. He's an associate attorney in the firm of Polano and Farrow in their corporate department. His practice is focused on advising various for-profit entities and startups on business matters relating to formation, corporate governance, and asset and stock sales. Welcome, Michael. Tell us a little bit more about yourself.
Well, thank you. It's a pleasure. Thank you. I appreciate you having me. As you said prior to, I'm an associate attorney here in the corporate group at Polano and Farrow. I do specialize in helping startups get off the ground, advising small businesses, and just through those first 5 years, you try to help them get on their feet and build a strong foundation for a future. And that's what we're here to talk about today is, selecting a legal entity structure. This is one of the most fundamental choices and one of the most important choices that an entrepreneur must make starting out. So when it comes to choosing the legal entity, it's important just to make sure that you understand what is out there for you. We always highly suggest talking to an attorney and consulting an attorney while doing this. It's important because I've seen so many clients that will come in and in order to get them the proper entity structure, we have to restructure the entity that they attempted to create on their own via whether it's LegalZoom, whether it's one of those other alternative legal service providers. And so that's something very important that we always try to stress to anybody that calls the office is, talk to the attorneys and the professionals who understand the different ramifications and can properly counsel you on the proper selection of an entity. Now, as I stated before, when you're seeking out starting a business, and you want to make sure that you are selecting the proper entity, not because it's going to lead to the success of a business, but selecting a wrong business, it may help contribute to why a business doesn't get off the ground. And the nice thing about entity structures is you can maneuver and change them as a business will change or mature and grow into the different stages of the business growth cycle. Again, it's important just to understand what types of entity structures are out there when you are starting out. So that's why it is suggested that you seek legal counsel when forming an entity. So there are, as we stated briefly, there's a handful of types of entities that an entrepreneur has to choose from. It's like I said before, it's one of the most important decisions you will have to make. There are several different types of entities and subversions of these entities. You can have a sole proprietor, you can have a partnership, which consists of general partnerships, limited liability partnerships. You will have corporations, there's professional corporations, and then there's different types of tax elections that you can make in a corporate structure. And then you have limited liability companies and professional limited liability companies. Now, starting out, the main things you want to consider are, okay, what is my risk tolerance? Usually it's going to be thinking about, okay, what do I want my liability to be? And taxes are going to be driving these considerations. I always like to talk to our clients, and at Polano and Farrow, we are very, very involved in the startup phase. We want to make sure we bring that different client experience, and we're right there helping them out every step of the way. And something I always like to ask each one of our clients is, where do you see your entity in 5 years? Do you see it? Do you see, adding people to the business? How do you want the relationship of those people to the business work? Do you see any of those people potentially transferring their ownership? And how much time and effort do you want to spend in the maintenance of the organization or creating it? Usually, what we tell potential clients and entrepreneurs that call us is usually on the front end of starting a business, to mitigate the risk and eliminate a lot of the risk when starting a business, it may cost more. But however, you want to build a strong foundation. You don't want to build a house on sand. You want to build it on a foundation of concrete. So the first type of entity, it's one of the most simplistic forms. It's called a sole proprietorship. Basically, a sole proprietorship, it's a person conducting business under their own name. And if you are conducting business under your own name, there are no special types of filings that need to be made with the county or the state. However, if you are going to do business under a different name, you must file what's called a doing business as certificate with the Monroe County Clerk's Office. And depending on the type of business that you must display that certificate. And usually this is the cheapest entity to form. The filing fees for Monroe County are a whopping total of $33. So the way it works in Monroe County is you'll go to the county clerk's office, you'll fill out that DBA certificate, and the county clerk will check for conflicting names to see if anybody is doing business under the name that you are looking to do business under. However, that's not always the case with every single county that you're going to do business as. Some counties will they won't even check for conflicting names. Some counties will encourage entrepreneurs to go and check for conflicts on their own, and they won't even refuse the filing if you do file the name under a name that's already existing. I've included a link here to go and search to see if your name or prospective name that you would like to conduct business under is being currently used in Monroe County. Now, as far as some of the characteristics of a sole proprietorship, as we stated, as a sole proprietor, you are the sole owner of the business. You control every aspect of the business. You run the day-to-day operations. You are the person. And being the person, you have a right to earn all those profits. And the nice part about sole proprietorship is any profits or losses that you have, you can deduct that against all of your other personal income. Now, the liability of a sole proprietorship is pretty substantial. A sole proprietor has unlimited liability for all the debts and obligations of the sole proprietor. What that means is you are on the hook for everything. Under different types of entity structures, as we'll discuss, the risk can be mitigated depending on the entity structure. A sole proprietorship is one of the most risky when it comes to liability. Now, as far as transferability and attempting to transfer a sole proprietorship, it cannot be done because a sole proprietorship is the human being himself. However, you can embark in what's called an asset sale, where you sell all of the assets of the business and the goodwill and going concern of the business, but you don't sell the actual business. And then a sole proprietorship will end upon the death of a sole proprietor. Now, taxation, this is a big one. A sole proprietor reports all of the income and expenses of the business on their individual return. And all profits or losses of the business are directly taxed to the sole proprietor. The sole proprietor is going to be liable for self-employment, Social Security, and income tax on any profits that are earned. And that's why we always recommend that if you are going to embark on a sole proprietorship, make sure you have the estimated tax payments. Another thing to fully understand is a sole proprietor, they're not considered an employee of the sole proprietorships, and therefore you are not subjected to any type of withholding or other employment taxes. Now, some of the advantages of a sole proprietorship. Starting out, it's very simple to go and form and maintain. It's simply taking a piece of paper and filing it with the Monroe County Clerk's Office. The nice part too is you have full control of the business, and any losses from the sole proprietorship, or the business of a sole proprietor incurs, it can be offset against any other types of income or other sources of income of that sole proprietor. Some of the disadvantages is a very big factor. The sole proprietor, they can only have one owner, and if you are eventually going to add another person, another owner into the business, it's going to require the sole proprietor to completely change its entity structure. And it's very difficult to raise capital from outside investors should the sole proprietor need to. And then the business, it's not perpetual. It's going to end upon the death of the sole proprietor. Now, the next type of entity that we have is a general partnership. A general partnership is another simplistic type of entity structure. A general partnership is an association of two or more people to carry on business for profit. And that's under the New York Partnership Law. Any person, any type of entity just about can be involved in a general partnership. The term person is defined very broadly. Like I said, it includes individuals, partnerships, corporations, and other types of association. A general partnership is unlike a sole proprietorship, it is a separate legal entity composed of its partners. A partnership must file to form a partnership. It's very simple. It's similar to a sole proprietorship. You file a business certificate with the county clerk's office. It's a similar form to the DBA form, and the cost for doing so is $34. Now, there is a document called a partnership agreement that is highly recommended. It's not required by law, but what a partnership agreement does is it governs the rights between the partners, whether it is discussing capital contributions, how the partnership is going to be managed. It's very important to understand and lay out these considerations inside of a partnership agreement. If there is no partnership agreement, there are certain presumptions under the New York Partnership Law. However, it's advisable that partners enter into a partnership agreement. So, going over some of the considerations you want to think about when forming a partnership and putting these considerations down to writing. The first thing is capital contributions of each partner. How much is every partner going to put into the business? Are we each going to put in $10,000 for 50% of the business? How is that going to be structured? And then if we need to put in more money in the business, what are the requirements that are going to obligate us to put more money into this business? And then is this going to be a side hustle for the partners, or is it going to be something that the partners are going to be going after? How much time is each partner going to be contributing to this business? Another thing is important is discussing the profits and losses in each partner's participation in. What that means is what is each partner's relative share going to be? So if the company makes $100,000 and there's two partners, how does each partner contribute and receive that $100,000 in profit? Is it going to be a 50-50 split? Is it going to be a 70-30 split? And the same goes for losses. If there is a loss at the year end for the business, how much of that loss is attributed to each partner? The other thing is understanding buy-sell arrangements, how the partnership is going to be dissolved, what events will lead to the partnership dissolving. And say there is a dispute among the partners, how is that going to be handled? Are they going to submit the dispute to an arbitrator? Are they going to appoint Joe from down the street to have the deciding vote? How are those procedures going to be effectuated? And again, all these are very complex and thought out considerations, and that's why it is important to, when structuring any type of entity, just to seek the assistance of legal counsel in helping you structure these agreements. Now, these are some of the general characteristics of the partners. Most of these characteristics here are what is statutorily laid out. For the management of the partnership, all partners are going to have an equal voice in management, unless your partnership agreement is going to specify otherwise. Now, for the profits and losses, partners that are going to share equally in the profits and losses, unless the partnership agreement is going to say otherwise. And when it comes to liability, this is another thing to consider with a general partnership. Partners are jointly and severally personally liable for all debts and obligations of the partnership. So if your partner enters into a contract for $1 million, where the partnership has to pay $1 million, you as a partner, you're on the hook for that personally. So if the assets and the assets of the partnership are unable to satisfy that contract, then your personal assets, aside from the partnership, are going to be used to satisfy that debt. And again, just going in, discussing authority and liability, every partner can bind the entire partnership. So this is why a partnership agreement is important, to limit those risks among the partners. So how to transfer partnership interest. A partner is allowed to transfer his or her interest, and the transfer will not dissolve the partnership. However, in the absence of an agreement, the person that is receiving that interest is not entitled to participate in the management, get any type of information or accounts, transactions of the partnership, look at the partnership books. All that transfer does from one partner to an assignee is it just gives them rights to earn income from the partnership. And then upon the dissolution of a partnership, any assignee of a partnership interest is entitled to receive that assignor's share of profits. Now, the taxation of the partnership. How is a partnership taxed? Partnership is not taxed as a separate entity. It's taxed similar to how a sole proprietor would be taxed. The only difference is the partnership is going to file an informational return, and then any profits and losses are attributable to the individual partners. So if, for example, if a partnership has $100,000 in profits and there is a 70-30 split in the profits, one partner is going to receive and get taxed on $70,000 and the other one's going to get taxed on $30,000. And the same will go for losses, because you can deduct losses against other sources of income. So using that example again, so if there's a $100,000 loss, one partner is able to use that $70,000 that was attributed to them, a $70,000 loss. They can use that against their other sources of income. And then partners are not considered employees, so therefore there's no withholding or employment taxes you need to consider. However, partners are still liable for self-employment tax, Social Security, and income taxes. Now, what are some of the advantages and disadvantages of partnership? To create one, it's very simple. There's very little formality need to establish and maintain the partnership. We'll talk about double taxation later on when we discuss corporations. However, there is no double taxation because there is no tax at the entity level. So all losses are able to be offset against other sources of income, and the partners are able to control jointly the day-to-day operations. The disadvantage The big disadvantage of a partnership is, again, going to that risk factor. A partner is going to have unlimited personal liability for all debts and obligations of the partnership. And again, a partner is able to go off and do something screwy and bind the partnership to various transactions, and thus you create liability for all of the partners. And then sometimes getting into when it's transferring a partnership, it can get very weird and very awkward, because it's one partner is wanting to leave the partnership, so it just makes for a weird relationship. And then again, like a sole proprietorship, a partnership, a general partnership is unable to have a perpetual existence. Now, there's another type of a partnership is called a limited partnership. A limited partnership is different than a general partnership. It's a special form where you're going to have a general partner and a limited partner. So the general partner is similar to the partners in a general partnership. The general partner is going to have unlimited personal liability for the obligations of the partnership. However, and they will be able to have the general management authority, where the limited partner, they do not participate in the management of the partnership or the day-to-day operations. But the counterbalance to the not participating to management is you are not going to be liable for the debts and obligations. Your only liability as a limited partner is the initial contribution, the initial money that you put into the business. Now, how to form a limited partnership? It's a little bit costlier. A limited partnership must be formed by the general partner by 1, you execute a partnership agreement, and 2, you file what's called a certificate of limited partnership. What that is, it's a document that you file with the state that notifies the state that, hey, we are a limited partnership, and doing that is going to cost you $200 to go and file with the state. And then there's a requirement that you publish the partnership. And what that is you take a notice out in a newspaper, and usually that's the notice will run for a certain amount of time, for 6 weeks for partnerships. And what'll happen is at the end of that 6 weeks, those newspapers, they will send you what's called an affidavit of publication. And then what you do with those affidavit of publications are you send those affidavits into the state with what's called a certificate of publication. And that will, that usually costs collectively between the certificate and the newspaper, that usually costs around $250 to do so. And, depending on where you publish will hike up the costs. Now, again, with the limited partnership, you want to consider much of the similar partnership agreement contents that we discussed before. You want to know, as a limited partner, you may want to limit the general partner's authority to enter into big transactions. How are disputes going to be handled? How is the company going to dissolve? What's going to trigger a dissolution of the partnership? And is there going to be any restrictions on what the partners can do outside of the limited partnership? Are they limited to only working for the limited partnership? Are they limited to certain types of businesses? So now the management structure, as we briefly discussed, you're going to have a general partner and a limited partner. The general partner, he is the person that's responsible for running the business. The general partners run the day-to-day operation and management of the limited partnership. Whereas the limited partners, they're silent. They are, in order to maintain that limited liability shield that's offered by the limited partnership, they can't participate in control or management of the business. If they participate in management or control the business, they lose that limited liability status. As I just said, if the limited partner participates in management, that limited partner may become liable, similar to what the general partner is if they participate in the control of the business. Now, what is control? Control is, think of management functions of the business. If you're going out and you're selling the goods or the services of the business, if you are making management decisions, under section 121.3 of the partnership law, they list out a myriad of things of what is not control. A limited partner, I don't want to read all the statutes to you, but limited partner can do a lot of things and not participate in the control of the business. But usually the line of control and not control has to do with the management functions of the business and running the actual business. If you're, as a limited partner, if you're starting to do much of the similar tasks the general partner, you are participating in the control of the business. Now, how are profit and losses taken care of? Profit and losses are in the partnership agreement. Obviously, there's, as stated before, in a limited partnership, you must have partnership agreement, and generally in every partnership agreement, if you consult an attorney, they will include a section that addresses how profits and losses are, how to be distributed and divided between the partners. If that's not addressed, it's allocated on the basis of values of the capital contributions. So if their partner put in 70,000 and one put in 30,000, there's going to be a 70-30 split for the profits and losses. Now, as far as the liability piece, for a general partnership, the general partner is similar to, or for a limited partnership, the general partner has unlimited liability to third parties. This cannot be altered by a partnership agreement. So a general partner is going to be on the hook for all obligations and debts of the partner, the limited partnership. The limited partner, on the other hand, as long as they don't participate in a management capacity, they are only, their risk is, and their liability is only up to their capital contribution. So if I put in $30,000 into a limited partnership and I'm acting as a limited partner, my liability is only up to that $30,000. Now, similar to a general partnership, in a limited partnership, the partner can only transfer the income rights, not the partnership interest. The assignee, again, it's the same thing as a general partnership. The assignee only gains the rights of the income. He doesn't gain any type of rights of the assignor. And the assignee, unless you have the consent of the other partners, the assignee will not become a partner. So how do I withdraw from a partnership? A limited partner can withdraw. Usually it's just addressed in the partnership agreement, but any limited partner may withdraw as it is provided in the written partnership agreement, or if all the parties consent to it. However, the partnership agreement is silent. The limited partner may not withdraw prior to the dissolution or winding up of the partnership. The withdrawal of any partner, general partner, shall be governed by sections 121.402 and 121.602 of the partnership law. So 121.402 provides a myriad of events similar to like a dissolution statute. It provides a myriad of events that that describe when a general partner will cease to become a general partner. And then 602 states that a general partner is allowed to withdraw at any time given written notice. But if they withdraw in violation of the partnership agreement, they will be liable to the limited partner. Now, dissolution of a partnership. You have judicial dissolution and non-judicial dissolution. Limited partnership is dissolved upon a myriad of events. It's in section 121.801 of the partnership law, and here are some of the events here. And then you also have judicial dissolution, which when a court says partnership, you are going to dissolve. Now, the taxation of a limited partnership, tax just the same as a general partnership. It's not taxed as a separate entity. The limited partnership files an informational return, and then all the profits and or losses are taxed to the partners. And then those partners can offset the losses against other sources of income. And then as a partner, you are liable for self-employment, Social Security, and income taxes. Some of the advantages, similar to a general partnership, there's no double taxation, and you can offset any losses or against other sources of income. If you are the general partner, you get to maintain control. And then if you are a limited partner and you want to be passive, you can be passive. You don't have to participate in control and worry about having, outstanding risks for liability. The disadvantages of it for the general partner is, like a partnership, you have unlimited liability. The limited partners are restricted from the management of the partnership. And then forming these limited partnerships can be expensive, and there are other usually more suitable entities than a limited partnership to effectuate what an entrepreneur or an entity, a budding entity, will need. So limited liability partnerships, I'll just briefly touch on these. Basically, they are a limited partnership for professional businesses only. And what is professional business? There's a lot of them. It is laid out in the New York Education Law, section 130 to 168. All of the formation and requirements of a limited liability partnership are those identical to those of a limited partnership. Corporations. Now, corporations are much different than partnerships and sole proprietorships. It's much more rigid, and this because a corporation, it's a separate legal entity distinct from its owners and the shareholders and the management, meaning corporation is a living, breathing human being. It's created, you file a certificate of incorporation with Department of State, and it's operated in accordance with the New York Business Corporation Law. There is a whole body of statutes that govern how corporations are supposed to function. The distinction of a corporation is the management are going to be different from the owners. Generally speaking, with a small business that's selecting to incorporate, usually the shareholders, the board of directors, and officers are all the same people. But as you grow, the shareholders are technically the owners of the corporation. What they will do as the owners is they elect the board of directors. And the board of directors, their job is to look at the 1,000-foot view and the overall management of the corporation. And these board of directors, what they will do is they will elect officers. Now, an officer of a corporation is a CEO, a CFO, CFO. Usually any of those, they call it the C-suite. Any of the C-suite employees of a corporation are going to be are C-suite officers of a corporation. Those individuals are responsible for the day-to-day operations. So the structure of a corporation, when it comes to stocks, you can have common stock, preferred stock. Usually there's different types of voting rights and distribution rights between the two. Smaller corporations will just have, one class of common stock. As you get larger, you may want to issue additional preferred stocks. The way corporations and the owners of corporations get paid is the corporation, they will make $100,000 in profit for the year. And that's, after you pay all of your employees, your expenses, bonuses, you have $100,000 in profit. So you're going to pay tax on that $100,000. And then that $100,000 you may distribute in the form of a dividend to the owners, which would be the shareholders. And then those shareholders are going to be taxed on their personal income of those dividend payments. You can do what's called an S election. which allows the profits to pass through to the individual shareholders. However, it may not be proper depending on the business, and that's depending on the business plans and what they are looking to do long term. An S election may or may not be appropriate. And that's why, again, seeking legal counsel will really help when looking to incorporate. And then if you are incorporating, if you have more than 2 shareholders, much like a partnership agreement, they have a shareholders agreement. And what that does is it governs the rights between the shareholders as far as how you are going to like buy-sell provisions. What is the price you are going to fix for your shares? How are you going to, what's the process for it? Is there a right of first refusal? Can I sell my shares to anybody? Because that's one of the nice parts of a corporation is you have this bundle of shares that are ownership that are freely transferable. And in order to restrict that, what is important is you enter into a shareholders agreement, because say you have a smaller corporation, you do not want to have 2 shareholders that are participating in the management, that are also on the board of directors and working for the corporation. You don't want a shareholder to just freely sell the group of shares, and then you have to deal with another human being that you may not want to run a business with. The nice part about shareholders, being a shareholder, and the nice thing about corporations is being a shareholder, you have limited liability you have limited personal liability from corporate debts and obligations. There are some exceptions to this. So if you are an officer of the corporation, you're personally liable for unpaid withholding taxes, unpaid sales taxes. If you are a smaller corporation, again with a couple of shareholders, you will be personally liable for unpaid wages. And then this liability shield, if you do something very gross and drastically different from the actual purpose of the corporation, purpose of the business, you'll be liable for that act. So how does the taxation of corporation work? So as stated before, a corporation is a living, breathing entity. It's going to file its own tax return and then pay taxes on any kinds of profits. Again, this is the concept of double taxation, which we referred to earlier. The profits, so say a corporation makes $100,000 after paying all its expenses and employees. That $100,000 is taxed at the entity level. So the corporation is paying tax on that $100,000. Then the profit, that bundle of money is then passed through to the shareholders via dividends. And then the shareholders are taxed individually on those dividends. Then any loss that a corporation may have can be carried forward or back to offset profits in other years. Now going to the S election. An S election allows flow-through tax treatment, meaning that $100,000 that we just talked about, the corporation will not pay that entity level tax. That $100,000 profit will flow right to the shareholders, and the shareholders will be able to use against income from other sources. The restrictions of making an S election. Not every corporation can make an S election. For a corporation to make an S election, you have to have only one class of stocks. The only thing you can have is voting differences. So you can't have preferred distribution rights for different shares, different classes of shares. You can have no more than 100 shareholders. And the shareholders have to be individuals. You are not allowed to have entities. You will, in certain cases, you can have certain types of trusts, but usually that's a whole different issue. And then shareholders, you cannot have foreign shareholders. Now, some of the advantages of incorporating. Being a shareholder, you have personal liability for corporate obligations, subject to some of those exceptions that we talked to. Generally, as a shareholder, you're not going to be liable for the debts and obligations of personally liable for the debts and obligations of the corporation. So when you go to raise funds for the corporation, investors, they're used to seeing a certain type of entity form, which is the corporate form. So it's much easier to sell the idea to them in order to raise capital. You have that centralized management structure. A corporation, it's going to exist perpetually. It doesn't die upon the corporation is a living, breathing thing. It doesn't die upon the death of a shareholder or upon the death of the people operating the company. Then the shares of a corporation, subject to any type of shareholders agreements, they are freely transferable. It's easy to sell off your shares. And there are certain other types of ancillary benefits, welfare benefit plans. Now, some of the disadvantages of a corporation. The double taxation, that is, short of making that selection, oftentimes you will have a double taxation on the same pool of money. The corporate structure is much more formal and rigid. There are certain requirements under the BCL that you must do annually and you must follow to maintain that corporate form. And to maintain this corporate form, it can be costly. Now, a newer type of entity that has come about is a limited liability company. These are unique in the sense where you can have the flexibility of a partnership, but you will have that liability shield of the corporation. And you can have and structure it in such a way where you can have all members participate or not participate. So a limited liability, the law establishing the limited liability company, the LLC is the short form of it. It became effective in 1994. Now, what an LLC is, it's an association of one or more people or entities which should conduct business together. A member of an LLC can be an individual, can be an entity form. And, again, going back to the member piece, the LLC owners, they're not called shareholders, they're called partners, they're called members. And in an LLC, instead of having shares, they call them membership units. There are no limitations on what the type of person or entity that can become a member, or on the maximum amount of people that can be members. Now, how do we create it? So the first thing you do is you file what's called an Articles of Organization. It's similar to that certificate of incorporation that we discussed. You take the Articles of Organization and file that with the Department of State. It costs $200 for doing so. And then after you file the Articles of Organization, you have to file a notice of, you have to give notice of formation. So this is similar to the limited partnership. You have to publish your formal notice that you've started the business in 2 newspapers for 6 consecutive weeks. One of the papers has to be published daily, and one of the papers must be published weekly. For many individuals that will attempt to form limited liability companies on their own, they often will miss this step. And now it can be rectified. However, it can be costly. And again, the cost of going through the publication process is roughly, depending on the publication cost, is going to be roughly $200 to publish, and to file the certificate of publication, it will cost $50. And then the most important document to organizing a limited liability company is the operating agreement. It's much similar to what the partnership agreement does. It establishes the relationship among the members. So it's like a shareholders agreement, a partnership agreement. It discusses certain things that certain things that the partner or the LLC will be doing. Again, when drafting the operating agreement and forming the LLC, I highly recommend you seek the advice of an attorney. I've had clients call before that have attempted to use LegalZoom, and they, instead of forming an LLC, they formed a corporation or a partnership, and they don't fully understand the process of what needs to go through and all the steps that need to be involved in forming the LLC. So now some characteristics of the limited liability company. Management of a limited liability company. It can be either member managed or manager managed. I know it's a mouthful. So unless a manager is appointed, all the members of the LLC have management rights. Usually, again, in the operating agreement, it'll address voting rights. Voting typically in an operating agreement, you'll see it in proportion to the members' ownership interest. Profits and losses, they will be shared in accordance with the terms of the operating agreement. So it'll discuss, and the operating agreement will discuss how profits and losses will be distributed to the members. If the operating agreement is silent, then it's based upon the value of the members' membership interest. So if you own 50% of the LLC or own 50% of the membership units of the LLC, you are going to be entitled to 50% of the profits. The nice part about an LLC is it has the management flexibility of a partnership, but you have the liability shield of a corporation. Members of a limited liability company will have the similar liability to those shareholders of a corporation. The liability of a member is to the third party for the debts and obligations of the LLC is limited to the extent of their capital contribution. Now, members can assume liability by stating so in the articles of organization. They can act as a guarantor on certain obligations of the partnership or the limited liability company. So there are ways to assume liability. However, generally speaking, members will have that limited liability. Now, to transfer a membership interest. So there is as members, they will have a restricted ability to transfer to third parties. You can only transfer the income rights, the rights to any money flowing from the LLC, but you cannot transfer your membership, management, or voting rights unless obviously the operating agreement says you can, or you have a consent of or a majority of the other members in the LLC. So there is a little restriction on the transferability of it, which is nice in some cases. The dissolution of a limited liability company. So there are an LLC, they can be dissolved at certain times as provided in the operating agreement. The articles of organization, they may provide that an LLC is supposed to only be around for a couple of years. The members, they can approve to dissolve the LLC. And then obviously the death, bankruptcy, withdrawal of any member specified in the operating agreement, or other events occurred in the operating agreement unless the members consent to continue. And then you do have judicial dissolution as well. Now, how is a limited liability taxed? Generally, a limited liability is not taxed as a separate entity. It's taxed similar to a partnership. An LLC, what they will do is they file an informational return, And then any types, they have the pass-through tax treatment. So any types of profits and losses are attributed to their members in accordance with their interests. You can have an LLC make an S election as well too. However, it's generally speaking, the LLC is taxed as a separate entity. Again, members, since they are taxed as a pass-through entity and a separate disregarded entity, members they're not considered employees of the LLC, and they're not subject to the withholding or other types of employment taxes. However, you will be liable for self-employment taxes, Social Security taxes, and always, if you are making a lot of money, like I know how many entrepreneurs are, it's highly suggested that you make estimated tax payments. Now, some of the advantages of the LLC, this is one of the most popular types of entity forms. And this is because you are going to have that flexible management structure of a partnership, but you have that liability shield of the corporation. That being said, LLCs, they can be rather expensive to form. However, if you are embarking on a new business venture, this is one of the most recommended entity structures that we make here. Obviously, you have the properly structured, you have the pass-through tax treatment, and so you're not taxed at the LLC level, and everything is flowed, all the profits and losses are flowed to the members in accordance with their interests and reported on their individual return. And then, unlike an S corporation, there's really no restriction on the type of owner, the number of owners, or the capital structure. So you can have membership, different classes of membership units with different distribution and voting rights. And usually what we see is, since entities are allowed to be members, it makes the LLC is one of those ideal type of vehicles for different types of joint venture opportunities. Some of the disadvantages, like a partnership, unless you specifically lay it out in the operating agreement, each member is individually authorized to act on behalf of the LLC, and they may bind the LLC in various types of transactions, thus creating liability for the entire LLC. You won't have the personal liability that you would in a partnership. However, the business is still going to be on the hook. Now, in drafting the operating agreement, it is highly recommended that an attorney is consulted, because you want to make sure you're not violating certain federal tax principles that would cause the LLC to lose the benefit of tax treatment and potentially be taxed as a corporation. And you want to make sure that you're addressing certain rights and management rights and responsibilities as it pertains to the members, who's responsible for what. Is there a certain type of vote for certain types of actions? What members can bind? What types of transactions can members bind to? Is there going to be managers? Is there going to be a board of managers? What's going to happen when there's a dissolution? Or what's going to cause a dissolution? How do members of an LLC, how do they get out of the LLC? What are the exit restrictions? So I'd like to thank everybody for listening in today. When it comes to forming an entity structure, there is a lot to take in, but it is highly suggested that call, whether it's us, whether it's another attorney in town, it's highly suggested that we discuss your entity structure with legal counsel.